There's been a raging debate out there between passive funds and active funds. Is there one better than the other? Michael Burry coming in saying that passive investing is a bubble. So what are your thoughts on those points of view?
Yeah, Michael Burry is very well respected, especially after he called out, besides the banking crisis, I also think he called out the dot-com bubble.
Did he?
Yeah,
okay.
Apparently. I mean, there's credit being
He calls something out every 2 years though.
Exactly.
Vandana here is someone that is physically very active. She's into mountaineering, she's into marathoning,
It's out of syllabus.
This is totally out of syllabus, but I must mention it here because it's a total dichotomy to passive investing.
From my 5th grade onwards, grew up listening to ledgers and credits and loans. A passive fund manager is far more busier than your active fund manager is.
Warren Buffett said after he's no longer around, he would want his wife's entire portfolio to be in. Hi everyone, welcome to Cashvisory's podcast episode. I'm Utkarsh, the co-founder, and we are on a mission to get every single Indian to their first investment. We have a very special guest here today. We have Vandana, and Vandana heads the institutional and passive business at Axis AMC. So we're going to learn so much about investing in general and passive investing specifically. So let's jump right into it. Hi Vandana, welcome to our podcast. So excited for the conversation that we're going to have, especially insights when it comes to passive investing for retail investors. So let's just get started with what got you interested in financial services and how did you start your journey?
Yeah, hi Utkarsh, it's lovely to be speaking with you. What got me into financial services? I guess I was cut out for financial services because I grew up listening to financial services at home.
Okay.
My father used to work for a public sector bank. My grandpa, my uncle, and we were a very close-knit family. So every evening conversations were about banking, about the technicalities of their job roles. So I pretty much from my 5th grade onwards grew up listening to ledgers and credits and loans and I guess I found myself familiarizing very early on with these financial terms.
Right.
Not necessarily concepts, but definitely with these terms. So it just seemed very natural that I decided to pursue this right from when the subject of choice of the course that you would want to take came up in school.
Yep.
So right from the 11th grade, I chose accountancy and commerce, and it just went on until PG. And then obviously when I went out looking for a job and came into financial services.
Got it. Super interesting. So you can say that it was kind of like your family business.
Yeah, but a very, very service class kind of a household.
Yep.
We know only salaries. So unlike some of you, we have to see that SMS and the first salary was $5,000 to whatever it is today. But yeah, runs in the family, you can say.
Okay, amazing. So you're currently heading institutional business as well as passive.
Yes.
If you could explain to our audience what that means.
Oh, wow. Yeah, I'm glad. And I'm sure most of the audience knows what passive is, and we're going to dedicate a lot more time discussing passives. But I think it's important that the audience also knows what institutional business is. Also, it is relevant from the context of passives, and I hope we get to speak about it a little more later. Yeah. But as a mutual fund company, we are selling not just to retail investors. We are also showing our products which are suitable for corporate treasuries,
right.
For banks, for institutions like NBFCs, insurance firms, and like you would presume, most of them do not look at equity funds.
Right.
They look at fixed income offerings. So there is a fairly large section of the asset management industry. By section, I mean a large portion of AUM, a large number of people like us who are focused on fixed income mutual funds. To give you numbers, it's 15 odd lakh crores on 68 lakh crores of AUM now, overall right. AUM. So I'm in charge of selling to institutions.
Got it.
For Axis Asset Management Company. So that's the institutional part of the business. On the other hand, I'm also in charge of the passives business, which is essentially index funds and ETF funds. And when I wear that hat, I'm actually going all the way retail to the other end of the spectrum, speaking to people like you who are in turn speaking to some of these retail investors, also speaking to retail investors whenever we get the opportunity, and speaking to them about passive way of investing. So that's what I do.
Got it. That's quite the scope. And
Yes.
I would say sort of working with institutions versus working for retail investors with retail investors would be very different.
True.
So how do you sort of reconcile the two extremes?
Yeah, you're right. They are two extremes. What I've noticed over the years now more than 20 years of doing this is both segments, investor segments, have actually evolved.
Right.
While we began our careers, there was a certain evolution that treasury heads in corporates had, and there was a certain level of complexity that you could have in a conversation to make sense.
Right.
But now clearly that has evolved a lot more. So it is a lot more of macro discussion. It's a lot more of risk-adjusted return kind of a discussion.
Yep.
Whereas when we are speaking to retail investors, again, the evolution has happened there, right? Significantly.
Yep.
The popularity of passives itself, while passive investing may not appear as complex, but the fact that passives has got popularized itself means that the retail investor has evolved so much, right? So there is a significant amount of evolution that's happened not only amongst retail investors, but also amongst people that speak to retail investors, which are advisors, which are channel partners, all of them. So the conversations there they could be more risk-adjusted return conversation, which is not yet there, but it is more in terms of meeting life goals, and so it's lesser to do with a fiduciary responsibility which is the hat a treasury head wears. And here, when we speak to someone, they're actually managing their own money, so there is no fiduciary responsibility involved. So a lot more ownership, and therefore a lot more time that I think the retail investor gives to their investments than what a corporate treasury does.
Absolutely.
So these are very top of the mind kind of differences that I can perceive.
Got it, and that makes complete sense. And speaking of the time that retail investors can give to their own investments, is a topic which is difficult for people to manage, because they have a full-time job, they have to take care of their family, they have to pay the bills, and when tax season comes, it's just depressing, right? So with so many things that are going on, how do you think a retail investor should look at their investments?
With so many things that are going on, a retail investor should actually see if she can give time to the very, very important activity of investments. Right? And why is it important? It's not just important from a financial security context, which it is, of course it is. But what's important is that investments is actually your second-hand income, so to speak. It is passive income, in other words, right? It's not in the context of passive investing, but as income itself, it's passive income. And therefore, as much seriousness as you give to your own profession, which you indulge in to earn a living, that an equal amount of importance has to be given to investments as well. If you're able to do as much justice, then you should not give it to anybody to manage for you, because who would know better than you yourself, right? And you're able to commit time and resources to it. But if you're unable to commit as much time and as much resources, please look for an advisor. And it has to be in safe hands. So look for an advisor who not only understands markets, but is also able to influence your behavior when the market is going through cycles. I think it's imperative for an investor to adopt this approach when looking at their investments.
Right, and that's a great point. I love the last point that you mentioned, which is the psychological aspect of things.
Yes.
When things go down, you need to have someone that's the voice of reason at the back of your head. So we end up doing that quite a bit for our clients. Right? So that is super important, guys. If you only two options: either learn it yourself or work with someone who can sort of guide you. And over time, you keep learning as you keep working with that person. So that's super insightful. And let's go a step deeper into this, right? Let's say a retail investor who doesn't have too much time, right? And let's say they don't even have the time to go look for an advisor, right? But they just want to get started with some investments. What do you think should be the first avenue that they explore?
Okay. So, I mean, I'm tempted to dive into, what comes top of mind, but I think I want to step back a bit, right? So if there is no time to manage investments, there's no time to look at an advisor or identify an advisor. I think the least that one should do is to see how much risk I can take.
Yep.
Number one. Which will influence my behavior, basically, right? Irrespective of what the goal is,
Yep.
My risk perception will influence my behavior, and behavior is very, very important. And also why advisor is important. But for a minute, we are assuming that, I, the retail investor, do not have the time to even look for an advisor. So I'll have to, if I'm that investor, then I'll have to, assess how much risk is, risk tolerance I have.
Yep.
That's number one. And I think the next very important thing is to figure out what I'm investing for, right? Once I kind of arrive at these two, then I move on to, therefore, which is the asset class that suits my purpose, right? And there are various asset classes. There is equity, there is fixed income, there is commodities, and there is Bitcoin and everything else, right? Of course, there is real estate, there is gold, but I would like to put that under commodities.
Right.
Then you arrive at that mix which will work for you, and then figure how you go about building each of this as part of your investment portfolio.
Right. That makes complete sense. And, just a practical hack for everyone watching. There's something called a risk profile assessment, and you could log into any sort of investment website, including Cashvisory, to do your risk profile assessment, and then you could understand what could be your starting point.
Sure.
Right? You've also spoken about so many of these asset classes, and I think this is something that tends to be a bit overwhelming for people.
True.
All the way from equity, bond, commodities, property, crypto. There's way too much out there.
Yeah.
So if I were to, again, going back to the original question, just get started with my first investment.
Yeah.
Let's put a bit more context and constraints to it, so that it can be more objective driven.
Okay.
Now let's say I'm a young person,
right,
out of college, working for 2 to 3 years.
Sure.
I do have some short-term goals, but most of my money is for the longer run,
sure,
because I have time in my hand. And obviously I don't have too much time to give to this.
Yes.
So how should I go about, and let's put another constraint. I've done my risk profile assessment on Cashvisory and it's come out to be adventurous. Okay. So how should I now go about
it? Okay, I'll suggest the asset class,
sure,
but it doesn't necessarily qualify only for adventurous kind of people.
Fair.
Right? So I think that for a young person just starting out, with medium to long-term goals, it's a no-brainer that they look at equity as an asset class for investing.
Right.
And within that, when I say equity as an asset class, obviously the most involuntary option would be that I go out and buy some stocks, right? Because that's what you keep hearing every day, around you. But what I'd recommend is for young people to actually pick up a broad market kind of an index, which gives them exposure to various sectors, which by the very nature of their size, I'm saying size because most of these indices are built on size as a metric, but because of the very nature of their size and their vintage, are very, very well governed companies, which means that you are investing in stocks eventually. However, they are stocks of a very well managed companies, and you are looking at an index which gives you, for even smaller sums of investments, an exposure to the entire portfolio of stocks, which you would have otherwise not been able to do, given the constraint on how much you may be able to set aside for investment.
Absolutely.
So so that's one option.
Got it. And that makes complete sense. And I was going to ask you a follow-up question in terms of what is an index, but I think you kind of explained that already as part of this answer, which is you're basically getting exposure to, let's say, the top 50 or the top 500 companies in India by market cap, right? There's been a raging debate out there between passive funds and active funds, and as part of Access AMC, I think you guys have both active and passive funds. But I think with your personal interest being more in passive funds, I don't know if this will skew your answer, but if I were to just ask you objectively, is there one better than the other?
Good question. So personal interest can lie anywhere. KRAs can lie anywhere. But I think that this is not only true for Axis, but this is true for the Indian asset management industry. This is true for the global asset management industry. Active has been around for longer than passive investing has been.
Yes.
Yeah. So that's clearly number one, right? We have all as professionals grown up in our professions, looking at, learning from, and benefiting from active investing, right? So there is merit and space for both active and passive investment styles to exist in your portfolio.
Right.
Of course, when you choose to fill in the active part of your portfolio, you'll certainly need an advisor, in my opinion.
Right.
You really cannot do away with some kind of an advice around it. Thanks to the myriad number of schemes that you will encounter when you try and learn things online.
Yep.
Thanks to different fund managers that you will learn about if you were to dig through a little more deeply. Thanks to different styles that emerge at various points in time. There is merit in having active funds in your portfolio because they are able to identify specific stocks which are likely to do well.
Yep.
And there is value in having that in the portfolio.
Right.
There is a huge space for passives as well, because that gives you an exposure to the stable market or the stable broad market of the portfolio. There is space for both would be my answer.
Got it. No, and we are aligned on that, right?
Okay.
Even at our end,
Yeah.
we sort of, when people ask us this question, our response is quite similar.
Okay.
The important thing is that, let's say if you want to get large cap exposure, right?
Sure.
You could either do it through a Nifty 50 index,
True.
or you could do it through, let's say, an Axis large cap fund,
Yeah.
right? The end outcome might differ by 1 or 2 percentage points.
Yes.
But the bigger decision point is for you to make that investment in the first place.
Absolutely right.
And you could come to that
Absolutely
nuances
right.
and come to your own conclusions
Absolutely
at the
right.
end of that exploration. So great to hear your thoughts on it. Let's go a bit deeper, because now passive investing is not just about your top 50 or top 500 companies in India anymore. There's a lot of themes emerging. There's a lot of what we call factor-based sort of investing themes that have come up, which use certain preset formulas and methods to determine what will be in your passively managed portfolios. So how do you see that changing the entire dynamic? And do you think people should get overly concerned about these themes?
Okay, so I'd say this way. So like you rightly said, there are broad market representing funds. What I mean by that is that you have, like you said, a Nifty 50, there is a Nifty 100 fund, there is a Nifty 500 fund. All of these are broad market themes, right? They are just purely put together by applying the filter of, if I may loosely put it as liquidity, basically by applying the filter of market capitalization.
Sure.
And those are funds that you would want to have in your portfolio because they just give you exposure to corporate India, and therefore there is a derivative exposure, consequent exposure to, if I may again put it very loosely, the nominal GDP growth of the country, right, of India. Now, if you're positive about India and you think that we continue to be the fastest growing economy in the world, and you want to benefit out of that, the route is to invest into corporates which are actually contributing to a large extent to that GDP. And some of these broad market funds are very true to label, vehicles which give you an exposure to those corporates. So that is that. Now, what the industry has been able to achieve is to get a little more nuanced around all of these things, right? Any market is not a calm water kind of a lake. A market is usually filled with ripples, sometimes waves. Sometimes those waves are like really big waves, right? So the analogy of ripples and waves is to market cycles, right? So we do notice that there are times, and there are reasonably longer periods of times when there are certain contributors to market returns. Now these contributors are nothing but factors. So that's what factor investing is all about. A factor is nothing but a contributor to market returns, right? So now what we do is that if I'm able to strip out from the broad market. A broad market is a broad market, right?
Yep.
On market capitalization. But from that big market, if I'm able to strip out either funds based on capitalization, which is I offer to you just a large cap index fund. I can offer to you a small cap index fund, a mid cap index fund. The other thing that I do is, listen, this is a phase in the market where companies with a very good return on equity, with very low leverage in balance sheet will do well.
Right.
Then to meet that requirement, I have a fund which will give you a portfolio of stocks which have formed a part of the portfolio via a rules-based selection.
Right. So focus on quality.
Which will focus only on quality, right? Or if this is a market where everything is doing well and there is a surge in price movement, then I offer you a portfolio which will track only price movements of recent price movement of stocks and offer you such a portfolio, and that's called a momentum portfolio.
Right.
So these are factors, right? And therefore, these are the various factors that are available to investors. However, by the very nature, and because I engaged in a longish kind of a description, by now it should be clear that these factors, which are not just the 4 very popular factors of low volatility, value, quality, and momentum, but also capitalization themes, etc. They can form the periphery of your portfolio.
Right.
They can form a satellite portion of the portfolio.
Absolutely.
Whereas the more core part of your portfolio has to be broad market index funds like Nifty 100, Nifty 500, etc.
Right. Totally agreed. And I think like in terms of how people should think about it, they should first not try to overcomplicate things.
Absolutely right. You're absolutely right.
And how you do that is by precisely focusing on broad-based indices.
Right.
And once you build that strong core, you go towards your satellite.
Absolutely right.
Talking of satellite, the other part, which is themes, because there are certain themes which are all the rage. We keep having people coming to us and asking us about EVs and asking about green energy and asking us about global tech. So how do you see these themes manifesting and becoming part of your satellite portfolio?
Yeah, so I think the key thing that one needs to look out for when opting for these themes is whether there are well managed and liquid stocks which are available for you to buy, right? There are great businesses. Some of these themes that you just mentioned, they are fantastic businesses, right? You really want to own a bit of what's happening in the private space in space exploration, right? In India right now, you'd want to do that, right? But just count the number of firms that are listed in the public markets, and therefore that are liquid, and you want to have them in your portfolios. So they're great conversation materials. If they become really big, they are going to make their way to the markets, right? To public markets.
Absolutely.
And for a retail investor, I think that it's very, very important to look at public markets first for 2 reasons. One is obviously to ensure that there is a certain regulatory oversight on governance when you're publicly listed, number one. And importantly, public market stocks give you the opportunity to own them with even smaller sums of investments. So themes is a great place to be in, but it's always better to look at broad market themes, because broad market themes, and I can get a little more detail on examples here, but broad market themes actually would have a number of sectors which would offer you diversification, which narrower themes may not.
Right.
And therefore, the risk element gets reduced to that extent, rather than just focusing on anything that's occupying a lot of print and media space, and trying to catch hold of some such fad.
Right.
So I'd say that some element of theme investing is good. If the theme were to boil down to more focused, segments or sectors, then a little more caution may be advised.
Right, and that makes complete sense as well. And I think another factor that, just to add on to your point of public and private markets, again, private markets don't give you liquidity as well.
Absolutely right. Yes.
So that's another very important piece, guys. If you were to go into investing into non-listed companies or even startups, which have become a very popular asset class, keep that in mind, right? I love the fact that you talked about the fact that certain themes which are all the rage, and talk of the town might not have enough investable opportunities.
Yes, absolutely right.
So I think wait for that to happen, right? Because as you rightly pointed out, those companies will become part of these major indices as these themes evolve.
Absolutely right.
Right. Yeah. So fantastic. And let's now shift the conversation to something a bit more controversial, right? Because we have, I think passive investing is relatively new to India, but it's been around longer in markets like the US.
Yes.
And there have been very famous investors like Michael Burry coming in saying that passive investing is a bubble. So what are your thoughts on those points of view?
Yeah, Michael Burry is very well respected, especially after he called out, besides the banking crisis, I also think he called out the .com bubble.
Did he?
Yeah, apparently. I mean, there's credit being
He calls something out every 2 years though.
Exactly. See, this time around, he's calling out passive investments as a bubble. He has his reasons, and the primary reason being that passive investing leads to inefficiencies getting stacked up in the market, getting built up in the market. There is credence to this because passive investors are not worried about so they are valuation inelastic, right? They're chasing prices, right? But then, we can argue on this, but that's not your question. And by the way, when Burry had a couple of nasty things to say about passive funds or passive investing, I think he deleted that tweet as well, which was in, I think he kind of made some comments. Obviously, he gave some interviews as well in 22, late 21, etc. Some of his tweets he has deleted, maybe he changed his mind. He's also been speaking about the US markets heading into a major slowdown since the last 3 years. Okay, so that is that. So I addressed Burry, but is there anything more you want me to address?
No, so I think in terms of how you addressed it, agree with most of your points, right? There can be some credit to what he's saying, but I think we should take everything that anyone says with a pinch of salt. Because we tend to get caught up with the fame that people have by virtue of times that they've been right in the past.
Absolutely right. You're so right. You're absolutely right. Influencers have a huge responsibility, I guess.
And I think a completely contrary view to this. So Warren Buffett said after he's no longer around, he would want his wife's entire portfolio to be in the S&P 500 index, right? So that's a contribute to it. It totally depends on how you want to look at it. But the thing is that you cannot go wrong with passive investing, especially when it comes to if you have a long-term time horizon. If you spread it wide enough, right? Then you're kind of doing a lot of the basic principles you're putting in place involuntarily, right? Which is something that we preach to all of our investors. Talking about passive investments, I think we've spoken about it from the perspective of mutual funds, and the different options that are available to people. In terms of investment strategies as well, what are some of the passive strategies, or I would say things that people can do to put their portfolios on autopilot?
So, I thought that you'll want to know more about some of the points that get raised against passive investing. So if you would permit me to just
please
dig a little deeper into that. So like we all know, and like I admitted, that there could be some risks of inefficiencies in passive investing, only from the standpoint that passive investors are price chasers, right? So as a passive index fund manager today, if you invest say 100 crores in my fund, then I'm not going to hold on to cash because I think the markets are very expensive, or because I think Trump is is going to sign off some 100 memos today of decisions, and therefore I'd like to see if the markets are going to tank tomorrow. I will make no such assessment on the market, right? Because I'm not taking those calls on the market. I have received 100 crores today. I'm going to go out and immediately invest those 100 crores in the market because cash is sin in passive. Okay, we do not, passive fund managers or passive investors do not use cash as a tool at all, as an investment tool at all. Cash is sin, okay, because we want to track the index.
Absolutely.
We do not want to outperform or underperform the index, right? So that's the objective. So therefore, there is an accusation that it leads to inefficiency in the market. But then, hang on, even today, after all the the firebrand growth that we have seen over the last Now, the massive growth that we have seen over the last 5 to 10 years, passive funds contribute to only about 30% of the global asset management industry, right? Which includes all passive asset classes, which is equity, fixed income, etc. In the world's largest market in the US, in equity, passive is as big as active, or maybe may have just edged out active a bit, right? So therefore, there are still very important, very relevant active managers in the market who are enabling price discovery. And that's why, passive and active coexist and have to coexist, right? It's not one or the other at all. It's not just because it's nice to say that, and it's not an or and it's an and, right? But it's also because it's important for market dynamics to play out well that active and passive managers coexist. Right? So active managers are still around to enable price discovery. The other big thing is that, passive managers track an index. How does the index get constituted? There is an active framework which goes into index formation. Right? A fund manager does not take the call of stock selection, but the index provider does. That's how indices keep getting rebalanced and stocks keep coming in and out of the index, right? So there is that little element of active management that also goes in while we are manufacturing indices, right? Sense. I'm going to put it this way, that passive investing is about benefiting from market efficiencies, and it is not about creating inefficiencies in the market, right? And usually passive investors are very long-term investors, because like you keep pointing out, right, you just fill it and set it aside, right? And therefore I'm not even looking at it because I'm not worried whether there is a fund manager who has taken a sudden call on a certain sector which I may not believe in, or there is a stock which is in negative news and I quickly have to look up portfolios to see am I overweight that stock or underweight that stock. All of that doesn't exist, right? So usually passive investors are very long-term investors. To give you examples, in India, the largest chunk of passive equity is contributed already by most of your listeners, which is via their EPFO or PF contribution, right? The EPFO is one of the largest institutional investors in Nifty 50 ETF and Sensex 30 ETF, which means that whether you are aware of index investing or not, or ETF is actually index investing, and I'll use one for the other, whether you are aware of index investing or not, whether passive is a new concept to you or not, you're already an investor. If you're earning a salary, then your money is, and a PF is deducted, then money is getting into these passive funds, right? And do you even care about your PF balance? I mean, how many of us have tried to withdraw or use it, right? So therefore, it's long-term money. Similarly, in the US, the bulk of the mutual fund industry's AUM comes from their 401k plan, which is a retirement plan, right? And therefore, this is all long-term investment. And a long-term investor just adds stability and efficiency to the market. So passive investing is not as much an inefficiency provided to the market as some of these learned guys like Burry tout about. So that's my response on this train of thought. Now I'll take up
that's
question.
Super detailed. But before you go to that question, I have a quick follow-up question. So now that a passive fund manager kind of just tracks the index, so what does the job of a passive fund manager entail?
Okay, so I have this favorite refrain amongst people here, especially when we are talking about task assignment and how many funds is one person managing and how can we improvise some of these things. So when we have some of these very small group meetings, my very, very favorite refrain to my CEO and my CIO is that, listen, a passive fund manager is far more busier than your active fund manager is.
Please explain that statement.
He is far more overworked than an active fund manager is. The explanation is as under. A passive fund manager's day is filled with ensuring that he's mirroring the index.
Got it.
There is a benchmark he just cannot afford to ignore, right? He has to completely, if it's Nifty 500, he has to stay invested in Nifty 500 stocks. Of course, there is another kind of passive investing which is called sampling, but that's for a more detailed kind of a conversation. But a long story short, a passive fund manager has always to kind of mirror the index, which means that any flows that he or she gets has to be invested in the proportion of the index.
Yeah.
Any outflow that they get has to be liquidated in the proportion of the index. There are corporate actions that happen. There is dividend flows that come in from most of these companies, etc. There are things like all of this is besides the rebalancing day activity that a fund manager has to do, right? So and their entire day gets consumed in mirroring the index. Now, bear in mind, some of the larger indices do have stocks which are not as liquid to execute trades into, right? Which means that if usually, and also you want to execute most of your trades in the later half of the day, towards the end part of the trading day, so that you're aligned to the index values as much as you can. However, through the day, you may want to build positions on some of these less liquid stocks, right? To ensure that you're maintaining that index balance. So if there is a 9 to 3 job, which is a high pressure job, it is the passive fund manager's job. An active fund manager, though, takes a lot more fundamental calls, right? He or she actually sits around and looks at sector allocations, reads a number of research reports, meets managements. So that's how they are exceedingly busy. But they don't really have to be at their desk to actually execute some of these stock picking or stock redeeming decisions or stock liquidating decisions as actively as a passive fund manager has to do. So there is a lot of active element involved in passive as well.
Got it. So I think if you were to summarize it, I think the key KPIs are different, right? For an active fund manager, the primary KPI would be to beat the index, whereas for a passive fund manager, it would be to track the index.
To track the index. You're absolutely right.
That's amazing. And now I know that you're itching to go to the next question.
Which is, I actually forgot the question.
So the question is, also some context, guys. So, Vandana here is someone that is physically very active. She's into mountaineering. She's into marathoning. This is
out of syllabus.
This is totally out of syllabus, but I must mention it here because it's a total dichotomy to passive investing, right?
Yes.
But now, how should, while maintaining that active lifestyle and being active in life, how should people make investing a passive part of their life? What are some of the strategies that you yourself use or you would recommend people use?
Okay, so see, I think that there can be a broad brush kind of an suggestion that one can give. I do not want to come from the perch of giving any advice to anyone. But it's all very individual, and who would know it better than you as an advisor, right? But what has worked for me really is that yes, I like to keep an active life. And there is joy that I derive from an active lifestyle. There is happiness that I derive from it. There is energy that I derive from it. So those are my motivations to keep at an active lifestyle. Also, it is an example that I set, not for the world but for myself, because it just helps me live the future by looking at the past, because I have expanded my boundary in being able to do something in these outside of work activities that I usually do. And I know that last year I ran this 50-kilometer race, and this year why should I sign up for 30 kilometers, because I've already done a 50. So my new benchmark is 50, right? And I'm like struggling and dying every day to train for that 50, right? So that's what some of these activities do, that they kind of set a benchmark for myself to keep expanding my boundaries, etc. But when it comes to everything else in life, be it my work or therefore the decisions that I take at work, etc., or be it my investment portfolio and therefore the decisions, etc., that I take there, everything is medium to long term. Nothing is short term. Nothing is chasing joys that way. But everything is towards a planned outcome, right? So to that extent, I'm a conservative person, maybe, and not an adventurous one.
Got it.
So essentially, it means that if I were to look at my investment portfolio, and this is where I do not mind wearing the advisor's hat, I have begun by first securing my financial life, present and future. And therefore, insurance is my first go-to financial asset, right, as part of my portfolio. And I call it an asset while I'm paying a premium, but I know that it's an asset, and I hope they'll honor claims if and when, and I hope I never have to claim. But insurance is used only for protection and not for investments.
Absolutely.
Right? And then I look at my investments the way I've been talking about. I see what my goals are. I see what my risk appetite is. Usually when it comes to the way I've kind of reconciled the two is that when it comes to a long-term goal, I'm okay taking risk.
Right.
I'm not that risk averse. Therefore, there is a lot of factor kind of funds in my portfolio because I want to, participate in every market cycle, right? I do not want to say that abhi market gir raha hai, so I don't want to be in markets. I want to say that, listen, if the markets are falling now, then, I want to have a factor that will help me tide over a falling market. If markets are rising, I want to be in a factor that will help me tide over a rising market. But fundamentally, there is a core part of broad-based index-led portfolio that I have. There is a significant part of my portfolio which is in equity funds with active fund managers. So, there are fund managers that I respect. There are fund managers who have proven their credentials across market cycles over decades. And I really see merit and value in what they bring to the table. It's a fund manager bias that they bring to the table, clearly. But it's a positive bias, in my opinion, over longer periods of time. So I think that, so the comfort of having a fund manager watch over your portfolio when the markets seem to be tanking, is an important reason why one should have active funds. Right? Index is tanking, markets are falling. I have a Nifty 50 or a Nifty 500 index fund in my portfolio. It's but going to fall. However, if I think that I have invested with the right fund manager, he may have taken a knock on his NAV, but it would probably be way lesser than what the market passive did, right?
True.
So there is a space, like I kept saying, for both. So for investors, it would be this, that, outdoors adventure risk taking is all great. But when it comes to, financial portfolios, it's nice to exercise prudence, if not caution.
Right, and that's amazing. I think that's the perfect note for us to wrap this up on.
It's been a pleasure.
It's been an absolute pleasure, and guys, I think the last answer was pretty motivational in terms of your personal aspirations, in terms of how you look at your adventures that you go on, but at the same time, how do you sort of look at your investment journey?
Yes.
And guys, it's very personal to you. So if you do have any questions that are coming to your head, if you would like to figure this out for yourself, do reach out to us, do book a free call, and we'd be happy to support you through your journey. Vandana, it's been an absolute pleasure.
Likewise.
Thank you so much.
Thanks a lot, Utkarsh.
I'm sure our audience has learned so much from you.
Yes, and I'm glad that I got this platform to speak to your customers.
Awesome.
Thank you.
And guys, don't forget to like, share, and subscribe, especially if you learn something new today. Thank you so much. Cheers.